Latika Chopra, the Executive Director at India Consumer Research of JP Morgan, is now joining in to have a conversation with us. Ms. Chopra, very good afternoon and thanks so much for joining in today to NDTV Profit. It's Puneet this side. Let me first start off with what you're currently seeing right now as we speak. We have seen GST-led momentum having a very strong impetus at the end of Q2. Q3 also, a lot of that continued in the month of October. Has that momentum continued according to you? What your conversations with the companies, if you can start us off with that perspective?
Sure. First of all, thank you for having me on the show. Always a pleasure. Clearly on the consumption front, clearly as you mentioned, there has been multiple macro tailwinds that we have seen in starting 2025, with GST rate reductions being the major one, which we saw towards the end of September quarter. As we see things on the ground, we did see a bit of an impact on growth for staples in September quarter due to the transition impact. Some of that kind of continued even in October. But since then, I think we have the new packs in the market. We have new price points in the market. Companies are looking at a steady to slightly improving growth trajectory, in the coming months. And I think they're hopeful that this momentum is only going to gather pace, as we step into the March quarter and more so in FY27. Clearly, the pace of consumption recovery is the single biggest aspect that investors are closely watching out for. We do anticipate that volume growth numbers should start to look up for the staple sector, in the coming months. And we are cautiously optimistic. There's a bit of guarded optimism because, we did have some of the false starts in the previous quarters, but we are hopeful, this time we will see a steady improvement in growth rates.
Hi Latika, this is Anushri joining as well. So, as we were just talking about the Nifty FMCG pack that has underperformed the overall Nifty 50 is what we are seeing for this year. While the GST rate cuts are in place, there was a transitory impact also seen in the Q2. The volume growth is expected to be healthier in the coming quarters. This is on account of price reductions also that we've seen in select categories. So just want to understand, why is the commentary still cautiously optimistic despite all of these factors which are now in positive? Because even if we look at the commodity prices, that are also on the better side that we are looking at. So just want your perspective on that front.
So a couple of things, as I was saying, starting 2025, we have seen, multiple interventions, whether it was, income tax cuts to interest rate cuts to, a good monsoons, and of course, increasing government support schemes, which should enable consumption. So through much of 2025, we have seen, growth numbers being fairly steady, barring this, minor transitory disruption that we saw in the September quarter. There is definitely a disconnect, between the stock performances and the trends that we have seen. I think a large chunk of that is on account of the fact that people want to see the consistency of delivery. They want to see that, the recovery is continuing to happen at a very consistent pace. And I think once companies start to showcase that, the stock performance will align with the growth trajectory. Why companies are cautiously optimistic? See, there are always multiple variables at play. If you look at the last quarter itself, it also saw a lot of weather-related disruptions, so to say, right? So certain categories got impacted disproportionately more. We have been seeing, urban consumption being a little tricky to gauge. It has been relatively lackluster. Rural has held out pretty well. So to that extent, the recovery pace is still, uncertain, and that is the reason probably why companies want to sound more cautiously optimistic than being very optimistic.
Right.
But our sense is, these numbers should improve and hopefully also reflect in a better narrative from the companies as we hear more from them, post the Q3 results.
Ms. Chopra, then what you mentioned a couple of key points that volume growth will be the key factor that you will be looking out for, and you expect that to start to happen now. Which pockets do you feel that investors should watch out for where that could happen much quicker than anticipated? Because within it, is it traditional consumer staples, durables, jewelry, quick commerce, amongst others? Because there is a wide basket. So and which companies do you anticipate that to be visible in very quickly?
Yes, so within staples, we are relatively more positive on the food and beverage space. I think there also the GST rate reductions have been more meaningful, and hence the volume growth recovery pace should be more visible or stronger in that segment. Having said that, home and personal care growth rate should also improve, but food volume growth and revenue growth should ideally outperform HPC. So that's one cohort. In discretionary, different variables at play for different subsegments. But I think a large chunk of retail names continue to benefit from shift from unorganized to organized. So organized grocery retail is a space where we are quite positive on. One can play through quick commerce. There are also offline retailers, which are at play. Of course, we have to be mindful of the competitive dynamics and the impact on profitability. But having said that, organized grocery retail is one space that we like. The second space, where we are incrementally getting more positive is home improvement slash paint slash adhesives. We think, after almost 2.5 years of slow growth in home improvement, we should see, some recovery coming back. So that is another piece. The third space, linked to the high-end consumption, where the premium consumption has continued to remain fairly resilient. And adding to that, the strong growth that we have seen in jewellery, organized jewellery retailers, I think that will be another space that at least over the next, 6 months or, should continue to post good, healthy numbers. On durables, we understand, it was a pretty tough 2025, because of weather disruptions.
Right.
We did see a spurt of growth coming back on festive. We do think 2026 should be a good double-digit revenue growth year for them, assuming the weather seasonality remains normal. The
Right.
only challenge that we see there is, the pace of margin recovery because of the competitive dynamics, that are playing out.
So, Latika, considering all of these brackets and all of these pockets wherein we are expecting better growth, if you just have to take it in basis of stocks, which are some of the stocks which would be right at the top of the category of this particular space that we are looking at? Because you spoke about jewelry as well. Now, there's some bit of volatility that we've seen in terms of gold prices as well. In QSR, what we've seen is that while there was healthy addition in terms of where the dark stores were concerned, now competition is one area that we should be watching out for. So just want to get your perspective. If you have to rank these brackets, which would be the top stock picks that you would have for FY26 for next year going ahead?
Due to compliance reasons, I cannot talk about stock specifics. But as I said, you can look at the top tier food and beverage names. That would be in our preference list. And similarly, in the cohorts that I talked about, again, some of the leading players in organized grocery retail, jewelry, and the paint sector, would be the ones.
Got it. Well, Ms. Chopra, thanks so much for joining in, giving us perspective on a whole bunch of spaces, as well as your view on what investors should look out for 2026. We appreciate your time here on NDTV Profit.